Hi, thanks so much for joining in. You're watching the Mutual Fund Show. Like the name suggests, we talk to you about mutual funds and how you should invest in them. And now we try to give you actionable insight to adjust both your portfolio strategy and also to identify themes and trends that could benefit you in your investment journey. Now, we have been looking at investments into mid-cap and small-cap mutual fund schemes as a theme in 2023. And look at the kind of money that has flowed into these schemes. Just in the small cap category, actively managed, as of the end of November, you had 37,000 crore rupees that flowed into these schemes. Now, the question that we're asking is whether or not an active strategy has worked, because in a lot of cases, actively managed funds in both the mid-cap and the small-cap space have failed to beat the benchmark. We'll talk about why, and we'll talk about whether or not a passive strategy might just have been a better idea, whether that's a better idea going forward as well. Joining me to talk about all of that and more, we've got Mrin Agarwal of Finsafe and Nikhil Kothari of Etica Wealth Management. Thank you so much to the both of you for taking the time. I will start, Nikhil, with you, and then I'll go to Mrin on her analysis as well. In data that you've sent me, and hopefully we can play that on the screen, you've said that a large number of the actively managed schemes in both of these categories have failed to beat the benchmark. Why is that?
What I'll say that, as you rightly said, that a lot of schemes have underperformed the benchmark, primarily all the index funds also. So the primary reason is that when the market is in one-way bull run, right? So then what happens is that a lot of fund managers may have some cash component in their portfolio, or maybe biased towards slightly some amount of money in large cap, because they may want to have some liquidity in their portfolio, that if there's a redemption pressure, they can sell the large cap and redeem that money and give back to the investor. So many portfolio managers keep some amount of large cap as well as some amount of cash. And that, because the small cap has been outperformed large cap hands down, so in that case, the active managed fund may underperform the small cap index as such. And same goes for mid cap index. So because in both this active managed funds like to have some amount of large cap, some amount of cash, some amount of stocks which are slightly less volatile, so that they can meet the redemption pressure. They can and broadly from a valuation perspective, a lot of fund managers are not very comfortable in the current context in terms of small cap and mid cap valuations. So they are slightly biased towards large cap. So because of that, we are seeing a good amount of underperformance in the last 1 year as compared to indexes. But if I take a longer picture, the numbers will not be as dramatic as what you see in last 1 year.
Understood. I will circle back and try to find out why the schemes that did manage to beat the benchmark did so. But Mrin, would you like to add to that in terms of the data that, and you've also shared similar data with me, why is it that you have a period of underperformance here when we're talking about the mid-cap index that is up some 38% and the small cap index that's up about 42%, and in some cases the underperformance is quite drastic?
So I think, Alex, as Nikhil also said, it's about the fact that the funds had to take some cash positions, of course, and also, with the sort of inflows that has been coming in, right, and those inflows have to be deployed, and it's not very easy to do that in small cap funds, right? So I think, that might have caused some lag in performance. Of course, again, all these funds do have exposure to large cap, and there has been a significant difference in performance between the large cap and the mid cap, and that also is adding up and causing a lag in the performance as well. But again, what I would like to point out is that the returns that we are looking at are category average returns, and it is not necessary that all the funds in the category are underperforming. Within the category, there are funds which are consistently doing well. I think the other thing also is that there are many in the small cap stock, there are many of the stocks that have done very well, may not have qualified in the due diligence for the small cap funds, and hence you would not really find these in these small cap funds. So I think it's a combination of factors that has actually led to this underperformance in the last 1 year. But again, when you do look at longer term timeframes, you do see a better category performance, and of course, fund wise, there are going to be differences.
Okay, in fact, let's talk about some of those those differences in approach and in stock selection fund-wise, right? Because if I look at, I'm looking at data, Nikhil, that you shared with me, and I see one of the schemes that has outperformed is Nippon India. And the reason I point out that in the small cap space is that this is the largest in terms of assets under management, and they've stopped lump sums a short while back. They have also a very large number of stocks in their portfolio, and I think they've had to do that because of what Mrin mentioned, which is that you need to be able to invest in some of these stocks. The float is not as much in some of these stocks, and therefore the avenues to invest are lower. What has worked for the schemes that have outperformed?
See, primarily, if I go with the specific fund which you said, obviously, what has worked for him is that because of large corpus and when we say even the inflows are coming in, right? So when the inflows are coming, it takes time to deploy that money, right? But since the corpus is very large, the new inflows have not determined the overall performance of those in that scheme. Secondly, the cash component is not that determined because again the size of the fund was huge. So even when the new flows coming in, even a small amount was there. Apart from that, large part of the money was already invested in stocks. So that has worked for them. Apart from that, see, consistency of fund manager is very, very important in small cap. Whenever there is a change of fund manager, and then you have at the same time you have a rally in the fund in the small cap index, then the underperformance can be dramatic because when a new fund manager comes in, by the time he changes from one stock to another stock, there can be delays, and because of that, they can be underperformance. But the consistency of fund manager here has really worked for the fund. Apart from that, this fund, the diversified approach of having such a large stocks, okay, and not limited to only few stocks. So he was able to pick stocks which are good governance and who has a better potential, and that has resulted in very good performance of the fund.
Okay, fair point. Mrin, so the list that you've sent me more or less matches what Nikhil has sent me. So what stands out in terms of approach? And I do want to look at it in terms of adjusted for TER, right? Guys, that's exactly what you've done. You've adjusted for TER and told me which funds have beaten the benchmark. There hasn't been a significant degree of beating the benchmark either, right? We're talking about a percentage point or two at the most.
Again, Alex, I would prefer to look at this from a long-term perspective. Sure. And again, first I'd like to talk about category returns. Again, and that's why I've shared rolling returns data over 7 years. And this is, of course, over the last 10 years. So it's like monthly average rolling returns on a 7-year period. When you look at the data, again, in the small cap, certainly at a category level, there's been a significant level of outperformance. And even at the fund level, you see a significant level of outperformance between the index and the fund itself. So I think certainly from a small cap perspective, there is that alpha that is being created. Yes, on the mid cap side, the performances are somewhere very close to the benchmark itself. And I think, what is really important is that one really needs to watch out for some amount of underperformance going forward. Of course, as Nikhil said, that, all these flows coming in are also contributing to that in some extent. So I think we need to just give some time to the fund as well to kind of, deploy the money and then look at performance more in the long term.
Okay, fair point. Now, I also want to delve a little bit deeper into the passive side of things and why the approach there might have been better off. But I'll do this after a very quick break. Guys, do stay with us, and viewers, we'll be back before you know it. Welcome back. You're watching the Mutual Fund Show, and we've established at this point that quite a large number of actively managed funds have failed to beat the benchmark in both the mid-cap as well as the small-cap space. Now, we've talked about the reasons why that has happened, but we need to also talk about the fact that a passive strategy would likely have done very well for you in all of 2023, particularly in the broader space. Let's talk about why that is. Nikhil, I'll come to you first. Now, obviously, you're talking about tracking error, and that is one of the key watchables when you're choosing the scheme. But there's a reason why the passive strategy has worked. Is that likely to continue going forward, though, is the question. So first, why has it worked? And second, is it likely to continue?
Okay, so why it has worked is primary reason is that the passives already have a predefined criteria based on that what the funds are selected, right? So as soon as the money comes in, they can deploy in the same stocks in the same day. So you don't have a lag when it comes to the deployment of money and the performance starting and the inflow of money. Second thing is that when we are talking about the index fund, when you're talking to mid and small cap, they will only invest in mid cap and they will only invest in small cap. They won't have any exposure to, like in a small cap fund, they won't have exposure to mid cap or a large cap. So if the difference of large cap and a small cap is substantial, then the passive will most likely outperform the active managed funds. Okay, but if the difference is narrowed down, or if, say for example, in cases when large caps outperform the small cap, in those scenarios, you will see an active managed fund may outperform passive managed fund because of stock selection criteria. Okay, so what has worked for passive is that the deployment money happens the same day, and you invest only in pure true to a label of stocks. So if it's a small cap, you only invest in small cap, and that has worked really well in the current scenario in the last 1 year.
Okay, fair point. Before we get into what is going to happen going forward, I want Mrin to also weigh into this and what she thinks specifically about passive as a strategy in the broader space. Mrin?
Well, I think, any portfolio always needs to be a mix of both active and passive funds as well. And I think, a portfolio that consists of a passively managed large cap fund with an actively managed mid cap and small cap would work well. Of course, the key really is in identifying the right funds within the space, because you want to get into funds that are consistently performing. And that's where I think the advisor can really help you. But I think a strategy which is a combination of both of these put together is a good idea.
Okay. It's an interesting point to make, and what you're saying is absolutely right, because most people have traditionally talked about large cap passively managed funds, but here we're talking about more options. And I'm just curious, is that because we didn't have too many options in the broader space that we always gravitated towards the large cap passive options, Nikhil? Or do you think that it's another reason that active is better at protecting downside when the tables turn and you see quite a big crack, particularly in the broader end of the spectrum?
Exactly. So incrementally, first of all, earlier, when you compare large cap, okay, the liquidity was good enough, and the passive were able to buy the same stocks without any impact cost. In last 1, 2, 3 years, the free float in mid caps and small cap has also increased, and now the liquidity is also there, so that even the passives are able to deploy the money in the similar fashion, and the index funds are able to track the indexes. So the tracking error has really come down. So incrementally, you will see that more and more money will not only limited to large cap, but people may look at passives, mid cap and small cap also. But one has to remember is that when the markets are roaring and it's going up all the time, right? Then you may see that passives outperform the active managed funds. But if the tide turns the other way around and the valuation becomes really expensive, and you see good amount of volatility in the mid and small cap space, in that time, the fund manager's ability to pick up right stocks with a good governance, with a good track record, that will become very, very handy at that point of time. And if you look at longer picture, right? So if you look at 3 years, 5 years, if you see that the active managed funds are able to beat the passive managed fund in the mid and small cap space, and which is going to happen only when there's a larger long track record, and you will see some volatility happening in the market, and you may see some correction in the market. But if the markets continue to be on the rolling on the one side, then you may see passives outperforming the active managed funds.
Fair point. So which is why we've seen in 2023 the kind of outperformance of passive, right? But here's the point that I want to make, Mrin, and I want you to weigh in on this as well. A lot of people tend to chase what is working in the moment, and so therefore they would ask, why should I not invest in a passive strategy in the mid and small cap space right now at this juncture, with both of these indices having given close to 40% returns in 2023? Why would that necessarily be not a great idea to go whole hog into something like this?
Well, I think as Nikhil also mentioned that, the passive, the actively managed funds are able to give you some amount of downside protection. So when I was looking at some data that was printed, I saw that the downside protection that one sees in small and mid cap funds over a 3-year period is roughly in the range of about 93%, like 87% to 97%. So they've been able to protect the downside pretty well is what I would say. And I think that's where the difference is really going to come. Of course, I think more and more, for some reason, when I'm looking at the data, I'm seeing that in the mid-cap space, even on the long term now, the number of funds that are consistently outperforming is actually coming down. So you might still take a strategy of doing a mid-cap index and an actively managed small cap. But the point to remember is that if you are entering markets at this stage, you certainly need to have that 10 to 15-year time frame and should not really expect any quick returns, because again, the standard deviation or the volatility that these mid caps and small caps have is pretty high. So I think, just keep the expectations right, and then it should be okay to do this combination strategy as well.
Okay, speaking of expectations, and that's absolutely critical, right? So we keep shouting about the importance of setting your expectations and also mapping your investments to a particular goal. So from that perspective, assume that you have a very long-term goal that you're investing in for this particular section of your portfolio, mid-cap and small cap, which you generally talk about in years and not in months. How should you go about rebalancing? Because I think, assuming that you have invested and you have continued to invest, there would be a skew. We're talking about what? For the large cap, assuming you went with an index strategy at the start of 2023, you've gained about 17.5%. Whereas if you went towards a mid cap or a small cap for that portion of your portfolio, and I'm only talking about equity, the skew would have gotten quite big, right? Because you're talking about anywhere between a 35 to 40% gain on that mid cap and small cap part of your portfolio. How would you recommend reworking that or reallocating that right now? Nikhil, first to you.
See, a lot of selection of the market capitalization also depends on the volatility, what you're able to bear and digest on that. See, if I go with my portfolio, I don't mind having my portfolio 50-60% in mid cap and small cap, but that may not be relevant for everyone, because when the correction happens, right, small cap can fall by 50, 60, 70% also. Are you able to digest that much volatility in your portfolio? Because the biggest thing in investing is not about what I invested. The biggest thing is about how long can I invest, and second thing is that whenever there's a dip, right, at that point of time, will I able to digest the volatility and not redeem the money? And more importantly, can I add more money in that time? Right, so the return will derive from those part of it. When the correction happens, are you able to stay in the market? Right. So if you believe that the volatility is not going to give you sleepless night, then you can have 40-50% of your portfolio in mid and small cap. Because India, the story is right now the more and more ideas will come in mid and small cap space, and that's why the fund managers are able to leverage that part of it. But if you are someone who can get jittery with the volatility, and if markets correct by 10, 15, 20, 25%, and you feel fearful about that point of time, then I won't recommend having good amount of exposure to mid and small cap. Then you better be in large cap space, because that will give you comfort on the volatility side of it. And the idea is, if you stay invested over a long period of time, if I take 10, 15 years, the difference between large cap and mid cap will not be more than 3-4%. The difference what you're seeing right now is just a 1-year phenomenon. But if I take a 10-year picture, the difference in CAGR will not be more than 2-3% in a mid cap as compared to large cap, and small cap maybe 4-5%. But volatility will be quite substantial. So you digest the volatility.
Fair point. We don't often talk about this on any of these shows, but when to sell is also important, right? And when to book a little bit of profit is also important. So I'm asking you now, Mrin, if you have gained significantly in some of the schemes that you're holding, particularly in the mid cap and small cap space, is this that moment to say, look, I need to sit down, it's the end of the year, I need to sit down, if there is a significant skew, I need to rebalance right now?
Well, of course, you should do a portfolio rebalancing once a year, and that could be calendar year end or financial year end. But how much to rebalance is now the question, right? And adding to whatever Nikhil has already said, what I would recommend is that maybe have like a number over which you want to do the rebalancing. So whatever your asset allocation is, let's say that you were 40% in equities, and then you say, okay, if it goes plus or minus 20%, that's when I'm really going to do the rebalancing. So that could be one way of going around it. And that's, of course, a very methodological way of going about it. But most investors do also bring in some amount of, their own thought process and what they feel the markets are going to do going ahead. So if you do that, and I think, most of us, do bring in some amount of personal gut feel as well. But if you do that, again, you need to be ready to face the consequences. So tomorrow, if there's a big fall and you've not really rebalanced, then you know that, okay, I don't have an option but to probably remain invested.
Understood.
So, I think these are the two things that you could look at doing.
So we do have to slip into one last break. But on the other side, we will talk about tracking error and what selection you should ideally try to make if you are thinking of a passive strategy on the broader end. Be back before you know it. Welcome back. You're watching the Mutual Fund Show, and this is the time when I'm going to ask my experts to give you some ideas if you are indeed going to invest in the passive space in the broader end of the spectrum. Now, Mrin as well as Nikhil, we've talked about various aspects of investing into mid and small cap, but it comes to the most important part, which is making a selection. How important is tracking error in the selection, and what, according to you, are the top picks? Nikhil, first to you.
Yep. So tracking is the most important because ultimately when you're investing in passive, you want to replicate the index. And the tracking error is high, then the whole purpose of investing in passive goes away. So you need to select a fund which has got a lower tracking error. Now in mid-cap index, the thing, because there are only 150 stocks, so it becomes quite easy to manage it. But when it comes to small cap, it's a very large universe. So when it comes to recommendation, I'll say the recommend a small cap stock which has a limit in terms of number of stocks. So personally, my recommendation will be that in mid-cap, we can select Motilal 150 mid-cap index, and for small cap, I will recommend Nippon small cap 250 index. So it's limited to 50 stocks, and both has done reasonably well in terms of mirroring their benchmark.
Okay, fantastic. Mrin, do you have to add anything on the tracking error side, and also what would you pick? I know that you've said that you should ideally look at a passive strategy primarily for large cap, and you've said on a selective basis you can look at mid cap as well.
Well, what I would say is that, this whole aspect of tracking error and tracking difference is something that investors find quite difficult to think about, right? So now tracking error is really the annualized standard deviation of difference in returns. Whereas tracking difference is actually the difference in the returns, right? And I think both of them do need to be looked in tandem instead of just looking at one number. So I think, what I've done is I've picked out three funds and I have shared the expense ratio, the tracking error and the tracking difference. Now, ideally, you would want tracking error and tracking difference to be low, right? And I think somewhere, we need to be tracking this for a longer period of time. So I think most funds are declaring it for 1 year. But ideally, again, these are numbers that you want to look at, for longer periods as well. And of course, the tracking difference is easier for most investors to understand. So I think if a fund is consistently having a very high amount of tracking difference, then certainly it's not your, it's not really your go-to fund really. But in terms of the fund recommendations, yes, on the small cap side, you could look at the Nippon Nifty 250 small cap fund, and on the mid cap 150 side, I would say that any of the funds would be good. I mean, anything with a low tracking error and a low tracking difference would actually be good. So my fund B that I've written over here, I think just look at it on that basis.
Okay, fair point. Thank you so much to the both of you for joining in and for talking about small cap and mid cap. It really has been the flavor of the season. But clearly, lots to talk about over the course of the day. We've got lots lined up for you on NDTV Profit, so do stay tuned.